Hello guys, welcome back to my YouTube channel. Like we discussed previously, we talked about Forex 101 in my previous class, which is the introduction to Forex trading, which included definition of Forex, Forex brokers, trading platforms for Forex trading, trading instruments in Forex, Forex time and sessions. So we stopped in these 5 topics. So we're going to talk about the remaining 2 in today's class. So let's look at the next slide and see what we'll have there. So today we are going to talk about Forex terminologies. You know, just like every field in life, there is a unique language peculiar to that particular field. So those that read law, for example, use some terms that are peculiar to them. Those that trade have their own term. I mean, those that trade in the local market and all that, they have their own peculiar term that they use during their daily selling and buying. Then doctors have their own peculiar language and all that. So likewise in Forex, we also have our own language, and you have to be familiar with these terms. You have to follow closely from here, because soon you would start meeting Forex traders around you, around your neighborhood and all that, and you need to know some of these terms for you to make sense of what you are saying, because you can't just come and be saying things that are just normal language that every other person knows. So we Forex traders have our own peculiar and unique language. So let's see the first thing we have here. Currency pair. Forex is traded in currency pairs. One currency is bought, the other is sold. Together they make up the exchange rate. In our previous class we talked about currency pair. You know, it's an asset you trade in Forex. So in Forex, 2 currencies are paired. You buy one while the other one is sold. You can also say that currency pair is 2 currencies from different countries that is traded in Forex. For instance, we have GBP/USD. So these 2 are paired together. So for you to have an exchange rate, you have to pair 2 currencies. So the next thing we have here is the exchange rate. The rate of which one country's currency can be exchanged for another currency. For you to have an exchange rate between these currencies, you have to pair them, just like you have a GBP and USD. So let's move on. The next thing here is a base currency. The currency that comes first in a currency pair is the base currency. Okay, here we have a GBPUSD. When you look at this currency pair, you see that GBP is the first one, which is the base currency. So let's see the next topic. Quote currency. Quote currency simply means the last in a currency pair. So since GBP is the base currency here, then USD is the quote currency. Let's move to the next slide. Long position, in bracket buy. So when you hear long position, it simply means buy too. So whether you use buy or long position, it's still the same thing. So a long position refers to the purchase of an asset with the expectation that its market value is set to rise. So when you're expecting a particular asset price to rise, that means you're going to buy that particular asset. Then short position, which is also known as sell. It's the opposite of buy or long position. So a short position refers to the purchase of an asset with the expectation that its market value is set to fall. So that's just the meaning of short position. So the next term here is bid price. Bid price simply means the market price for the sale of an asset. For example, let's say you want to buy a t-shirt and you go to the market to buy the t-shirt. So when you get to the store and you ask the seller, how much are you selling your shirt? And the person says, for example, 5,000 naira. So 5,000 naira is the bid price for that particular product, because that's the price the person is willing to sell the t-shirt. Then ask price. The market price for the purchase of an asset is known as ask price. It's more like bid price is for sellers and ask price is for buyers. So ask price is the price that the person that came to a shop to buy t-shirt is willing to buy for that particular shirt. Just like the seller told the customer that came to our shop to buy t-shirt that the price is 5k. Maybe if the buyer is not comfortable with the price, he can ask the seller to sell it for 3,000 naira. You can say that bid price is a price that a seller is willing to sell a particular asset while ask price is a price that a buyer is willing to buy. So that's just the simple explanation for these two. Then we have spread. The difference between the bid and ask prices is known as the spread. Like I said earlier, the seller is willing to sell 5,000 naira, but the buyer is willing to buy at 3,000 naira. So if you check the price difference between the buyer and the seller, you see that 2,000 naira is the price difference. So that 2,000 naira is the spread in that particular transaction. So let's see the next slide. Okay, PIP. A PIP stands for percentage in points. It's the smallest price movement any exchange rate can make. It measures the amount of change in the exchange rate for a currency pair in the forex market. Pips also means the quantification of profits and losses. Okay. In our Forex 201, both bid and ask price, spread, PIP, and some of these topics are a lesson on their own. So we are going to break them down in details. So even if you don't understand some of them here, you still get to know the meaning by the time we get to our Forex 201. So a PIP stands for percentage in points. That's the long form of it. PIP is a kind of a measuring tool that measures the fluctuation of price in a particular asset. For instance, if GBPUSD moves from 1.1 USD to 1.2 USD, PIP will be used to calculate that particular movement. So let's continue. The next topic here is lot size. Forex is traded in lots. A standard lot is equivalent to 100,000 units of a base currency. A mini lot has 10,000 and the micro lot has 1,000. No need to talk much about this here because it will take much of our time. So in our Forex 201, we will discuss lot size very well there. We'll digest it and give you examples with charts and all that. So let's move on. The next thing here is the leverage. I think I've mentioned this before. Yeah, in our previous class, I talked about leverage, where I mentioned brokers giving leverage to traders for them to be able to trade in the forex market. Yeah. So leverage is a way for an investor to increase their trading power and manage a greater position on the market with a nominal investment. I've already said something like this in our Forex 101. So let's keep going. Most online brokers offer leveraged trading for up to 1,000 times the value of a trader's initial investment. You will find brokers listing their leverage as follows: 1:50, 1:100, 1:500, and 1:1000. Let's take for instance, you have $100 in your account, or you invested $100 in your trading account. So let's use 1:100 as you can see it from here. So the $100 you invested is assumed to be this one. I know we all did ratio in our secondary and primary school, so this should be understandable. So your $100 stands as this one, then your broker gives you this 100. So your broker multiplies your $100 to 100 places. So you'll be able to manage bigger amount of money and something like that. So let's move on. The next term here is volatility. Volatility simply refers to the price fluctuations of assets. It measures the difference between the opening and closing prices over a certain period of time. Fluctuations of assets. That's just the simple definition of volatility. Bulls. In forex nomenclature, buyers are referred to as bulls. I talked about buyers before, where I said go long, buy. So they are referred to as bulls too. So when you hear buyers or when you hear bulls, they are the same thing. When you hear go long, they are still talking about buyers. So buyers are referred to as bulls. So whenever you hear a forex analyst or you get a news that the bulls took over the market, they simply imply that buyers took over the market. Then bears. This is the exact opposite of bulls, and it refers to what? Sellers. So bears are the sellers and bulls are the buyers. Let's move on. Bullish market. Bullish market is one that is going up. Since you are told that bulls are buyers, so bullish market should be going up. Then bearish market is one that is going down, which is bears. So if the bears are in control, then the market will be going down, and if the bulls are in control, then the market is going up. The next term here is trending market. When the market is said to be trending, it simply means that it has a particular direction. It's either bullish or bearish. So it simply means that for a market to be trending, it should either be bullish or bearish. Then, ranging market. When a market is said to be ranging, it simply means that it has no clear direction. It's neither bullish or bearish. It is just revolving and bouncing around two fixed points. This is an exact opposite of trending market. So when market is just moving between two prices, going up and coming down without having a clear direction, it is said to be ranging. So the next topic here is the forms of trading forex. So let's see what we have. Okay, the first form of trading forex is fundamental analysis. Yeah, or you can also call this news trading. Fundamental analysis is a form of trading whereby you use news, the information you get from maybe CNN, CNBC, and all those places to trade the market. Just like what is happening currently, Russia and Ukraine is having some issues, so that's a fundamental analysis. And this particular news affects the forex market, either negative or positive. So with this upset among Russia and Ukraine, you should know that it will affect the economy negatively, because when there is war, people don't go to the market to buy stuffs, people don't go to bank, people don't even move around. Everybody's indoors, trying to protect themselves. So this also affects the investors that move the forex market. When there is violence in any part of the world, it tends to affect the global market. Forex is a global market. Every country participates in it. So when some countries are having issues, it will generally affect the market. So currently, this Ukraine-Russia upset is affecting the market negatively. So it means that the price of assets should be going down. So that is fundamental analysis for you. So let's move on to the next one. So we have this particular news that is called NFP, which is the non-farm payrolls. It's a news that is being released by the US every first Friday of every month. So this is the populist news that everybody knows. Every forex trader knows NFP. It is being released every Friday of every month by 1:30 GMT. Let's see what we have in the next slide. Technical analysis. In forms of trading, we just have two forms of trading, which is fundamental, which I already explained, and technical. So technical now involves using price actions, candlestick patterns to analyze the market. So this is the basic thing we forex traders use to trade. We use this technical analysis to analyze the market on daily basis or on weekly basis to get our entries and exits during our trading time. We have types of technical analysis which include the candlestick patterns, resistance and support, Fibonacci, supply and demand, and many other ones. So this is where we are going to stop for today, and this is the end of Forex 101. So we'll continue with Forex 201 in our next class. So make sure you are there. Subscribe to the channel if you've not done that. Also like the video and share to your friends too. So we're going to stop here for today, and we are going to take time and explain these concepts. We are going to explain these candlestick patterns, explain support and resistance, Fibonacci, and supply and demand. So I will make a video on each of these and explain them very, very well. So as you can see, we have a lot of things to do. So make sure you don't miss any of our classes, so you don't have to stay behind. So make sure you are up to date with our classes. Subscribe to our channel like I said already, and thank you for listening.